Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies of Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 45 is portfolio evaluation. Before going to discuss about the portfolio evaluation, let us understand which concept has been discussed in the previous class. In the previous class, we have discussed about portfolio evaluation and its introduction part. And now we are moving on to the portfolio evaluation. The main objective of this chapter is to provide an overview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. Once the student attending this particular session, he will be able to understand the concepts of portfolio evaluation. Portfolio evaluation refers to the evaluation of the performance of the portfolio. It is essentially the process of comparing the return earned on a portfolio with the return earned on one or more other portfolios or on a benchmark portfolios. The evaluation of portfolio performance is important for several reasons. First, the investors whose funds have been invested in the portfolio needs to know the relative performance of the portfolio. The performance evaluation methods generally fall into two categories, namely conventional and risk adjusted methods. Similarly, what is the meaning of portfolio we need to understand? A portfolio is a grouping of financial assets such as stocks, bonds, commodities, currencies, and cash equivalents, as well as their fund counterparts, including mutual, exchange trade, and closed funds. A portfolio can also consist of non-publicity included non-publicly tradable securities like real estate, art, and private investments. Keeping this in view, how do you calculate a portfolio? That is very important question. Here, the steps are there to evaluate the portfolio. That is, step 1, upload your portfolio to an investment tracking tool. The first step is to input your portfolio into an investment analysis tools. There are different statistical tools are available. Step 2, evaluate your stock and bond allocations. Step 3, evaluate stock allocation. Step 4, evaluate bond allocation. Step 5, evaluate specific funds. Step 6, evaluate advisor fees. So here, what is a performance portfolio then? Portfolio performance measures are a key factors in the investment decision. These tools provide the necessary information for investors to assess how effectively their money has been invested or may be invested. Evaluation of portfolio risk. Number 1 is tracking error. When it comes to investing, tracking error measures the standard deviation of excess return compared with a common benchmark. Share ratio. The share ratio represents the risk adjusted return of a portfolio. Information ratio, beta, trainer ratio. There are different evaluation methodologies are there, so one has to understand completely. The best portfolio for retirement. Here are the few suggestions for ensuring you make the smartest portfolio evaluation methods. Possible decisions with your retirement savings. You have to buy bonds, maybe on rental real estate, variable annuity with a lifetime income rider. Keep some safe investments, income producing closed end funds, and you have to invest your portfolios which gives you dividends and dividend income funds. There are some trusts who can give you some returns, that is real estate investment trusts like that. Portfolio management process. Portfolio management process is an ongoing way of managing a client's portfolio of assets. There are various components and subcomponents of the process that ensure a portfolio is tailored to meet the client's investment objectives well within his constraints. How do I plan for portfolio? So here are some of the questions that I need to address. Create an awesome design portfolio with these 20 pro tips. Be thoughtful about what you include. List designs things. Select only your strongest pieces. Showcase your most unique and creative work. Go for varieties. There are different options are available for investing your money on various uh, portfolios. Decide on how many pieces to include. So you need to decide about the physical portfolio. Go high resolutions. Stay current. You need to keep updating and what happening in the market. Everything you need to keep watching, whether it is increasing return or decreasing return. So you have to be very cautious while evaluating the portfolios. Investing in a portfolio involves both return and risks. In order to evaluate the performance, we should consider both aspects. Evaluating a portfolio performance involves comparing it to an appropriate benchmark. Which is better, shapes or tenors? There are two different methods are there. While standard deviation measures the total risk of the portfolio, the beta measures the systematic risk. Therefore, shape is a good measure where the portfolio is not properly diversified, while trainer is a better measure where the portfolio are well diversified. Evaluation of a performance of a portfolio manager. Here manager also plays an important role. Performance attribution interprets how portfolio managers achieve their performance and measure the sources of value added to a portfolio. To determine success, the managers seek to outperform their scheme's returns with respect to a benchmark. This excess return with respect to the benchmark is called active return. Here, there are three different evaluation methods are there with regard to portfolio. Number one is Sharpe ratio. A Sharpe ratio is a measure for calculating risk-adjusted return, and this ratio has become the industry standard for such calculations. It was developed by Nobel laureate William F. Sharpe. The Sharpe ratio is the average return earned in excess of the risk-free rate per unit of volatility or total risk. Subtracting the risk-free rate from the mean return, the performance associated with risk-taking activities can be isolated. One intuition of this calculation is that a portfolio engaging in zero risk investments, such as the purchase of US Treasury bills, for which the expected return is the risk-free rate, has a Sharpe ratio of exactly zero. Generally, the greater the value of the Sharpe ratio, the more attractive the risk-adjusted return. The performance measure developed by William Sharpe is referred to as Sharpe ratio or reward to variability ratio. It is the ratio of the reward or risk premium to the variability of return or risk as measured by the standard deviation of return. Modern portfolio theory states that adding assets to a diversified portfolio that have correlations of less than 1 with each other can decrease portfolio risk without sacrificing return. Such a diversification will serve to increase the Sharpe ratio of a portfolio. The formula for calculating Sharpe ratio may be stated as Sharpe ratio, mean portfolio return minus risk-free rate divided by standard deviation of portfolio return. In the same way, we have another method of evaluating portfolio, that is proposed by trainer ratio. So trainer ratio, what it says? A ratio developed by Jack Trainer that measures returns earned in excess of that which could have been earned on a riskless investment per each unit of market risk. Trainer is a measurement of the returns earned in excess of that which could have been earned on an investment that has no diversifiable risk, either treasury bills or a completely diversified portfolio, per each unit of market risk assumed. The trainer ratio relates excess return over the risk-free rate to the additional risk taken. However, systematic risk is used instead of the total risk. The higher the trainer's ratio, the better the performance of the portfolio under analysis. Formula where trainer ratio portfolio is return risk free rate portfolios beta. There are different types of components are available in this trainer's ratio. We have another method of evaluating the portfolio evaluation method, that is Jensen's measures. Jensen's measure says a risk-adjusted performance measure that represents the average return on a portfolio over the above that predicted by the capital asset pricing model, given the portfolio beta and the average market return. This is a portfolio's alpha. In fact, the concept is sometimes referred to as Jensen alpha. The basic idea is that to analyze the performance of an investment manager, you must look not only at the overall return of the portfolio but also at the risk of that portfolio. For example, if there are two mutual funds that both have 12% return, a rational investor will want the fund that is less risky. Jensen's measures is one of the ways to help determine if a portfolio is earning the proper return for its level of risk. If the value is positive, then the portfolio is earning excess returns. In other words, a positive value for Jensen's alpha means a fund manager has beat the market with his or her stock packaging skills. Dear friends, so now to summarize this particular session, the portfolio performance evaluation essentially comprises of two functions: performance measurement and performance evaluation. Performance measurement is an accounting function which measures the return earned on a portfolio during the holding period or investment period. Performance evaluation, on the other hand, address such issue as whether the performance was superior or inferior, whether the performance was due to skill or luck, etc. Dear students, let us understand a few of the concepts through multiple choice questions. A portfolio is a grouping of dash such as stock, bonds, commodities, currencies, and cash equivalent, as well as their fund counterparts including mutual, exchange traded, and closed funds. There are four options available for this. Option A, products. Option B, physical assets. Option C, financial assets. Option D, cost elements. Can anybody guess the answer for this? The answer is option C, financial assets, such as stock, bonds, commodities, currencies, and cash equivalents are all financial assets. The other questions is, when it comes to investing, dash measures the standard deviation of excess return compared with a common benchmark. Which is measures the standard deviation? There are four options available for you. A, tracking error. B, syntax error. C, communication error. D, common error. Which type of error that commonly measures the standard deviation of excess returns? Anybody guess? The answer is tracking error. Number 3. Dash are predetermined rules used in portfolio revision strategies when buying and selling securities. Four options we have. A, financial plans. B, assets plans. C, investing plans. D, formula plans. What could be the answer for the question number 3? The answer is option D, formula plans. Formula plans are predetermined rules used in portfolio revision strategies when buying and selling of securities. The fourth question says, a dash is a standard or measure that can be used to analyze the allocation risk and return of a given portfolio. We have four options. A, benchmark. B, watermark. C, permanent mark. D, remark. Any guess? The answer is A, benchmark. A benchmark is a standard or measure that can be used to analyze the allocation, risk and return of a given portfolio. We have another question, that is, dash is a measurement of the returns earned in excess of that which could have been earned on an investment that has no diversifiable risk. For example, treasury bills are completely diversified portfolio, but a huge rate of market risk assumed. What could be the answer for this? Option A, return on investment. Option B, Fisher's index ratio. Option C, fixed asset ratio. Option D, trainer's ratio. What could be the answer for this? The answer is D, trainer ratio. Like that, friends, there are so many reference books and the resources are available to understand regarding evaluation of the portfolio. You have to go through that in order to understand the complete details about this. Thank you for giving me an opportunity and I wish you all the best. Good luck. Thank you so much.